Hi guys, Wade Curtis, the founder of Curtis Property Group. Today I'm going to show you a real life case study of proven results that our clients are actually achieving using one of our investment strategies. So this particular client or clients, they're a married couple with one dependent and aged early to mid 40s. They own their own home, or don't own it, but paying it off. And they've got a household income being a dual income, meaning both husband and wife are working. So I can't disclose the exact income, but in between $100,000 and $150,000 disposable income. The equity they have access to in their own home was about $250,000. So when we sit down with all of our clients, what we do is we establish what it is you're actually trying to achieve. Now, this particular client, they wanted to retire on an income of $70,000 per annum in today's dollars. So their timeline in order to do that, they had 20 years before they retire. So the action plan was they're already paying substantial amounts of tax, massive amounts of tax on their taxable incomes. So we needed to get some good tax deductions through the property investment strategy. So what we did is we used a 10% deposit option. So we borrowed out of the equity around $70,000, so which is equivalent to a 10% deposit for your stamp duty, your 10% deposit, and your legal costs. It's your general associated cost to get into an investment property, or any property. So what we did with that $70,000, we were able to find them a great brand new investment property in a high growth area. So really good performance, projected returns. So what we did was we spent $530,000 brand new. So we're maximising the tax deductions through depreciation. Depreciation is the best tax deduction you can get, is because it's a non-cash outlay. We don't have to pay any money for that. It's a free tax deduction. So we want to utilise that for this particular client. So that's why we went brand new. We've got a 10% deposit option, and the beauty about it is it's cash flow positive. So it's actually not costing them money out of their week-to-week income, which is a fantastic result. That was in the first property. This is the second year. We were looking at the strategy review, and now they're able to, or have gone ahead with their second investment property. So what we did is we sit down, we value the two assets, and then we establish that, yes, there's some more usable equity that we can get. We've had some growth, so we can actually get some more equity out. So we borrowed out a little bit more equity for property number two. The second property, we paid about $498,000, call it $500,000 purchase price. That was in a high growth area of Brisbane, great market, really good capital growth, and really good projected returns. That is also cash flow positive. So we're able to find a builder that actually built the property pretty much without any interest through the construction. So we really saved our clients probably $8,000 or $9,000 in interest through the construction period, which was a really good, a really good result for them. The property is cash flow positive. So two properties in 2 years, which this is building the foundation. We call it the accumulation phase of building your portfolio. So now we're looking to duplicate it and do a property each year for these clients for the next 5 or 6 years. So in order to achieve the $70,000 per annum in the required time frame, we're going to have to do that. So we've mapped that out. So we're working really, really closely with our clients to be able to achieve those results. So the result, $1 million portfolio in 2 years. 18 months was basically the timeline when they kicked the second one into gear, but by the time it's finished and shifted into and rented. So they're both cash flow positive properties. The client's got a monster tax return, a massive tax return. So, in the vicinity of $16,000 or $17,000. So they were really excited. That was their family holiday. And now they're really excited to get the second tax return at the end of June, because obviously they'll be getting more deductions back, paying less tax because they've now got two properties. So cash flow positive after tax, brand new properties to maximise depreciation and holding costs. So that there is obviously a low maintenance asset as well, being a brand new property that you're not exposed to excessive maintenance. So a really good strategy, and one of our strategies, and suited this particular client perfectly. So that's case study number 2. So thanks for listening, and look forward to our next case study.